price does not reveal its intentions all at once. It moves in phases, shifts in control, and leaves clues behind as it transitions from one state to another. When these clues are viewed in isolation, the market feels inconsistent. But when they are understood as part of a sequence, price behavior becomes structured, readable, and repeatable. Welcome back to the ComLucro channel. In this video, we are going to solve that problem. Instead of looking at fair value gaps or structure as standalone ideas, we will connect them into a single, logical process. You will see how market structure sets the directional bias, how shifts in control appear before major moves, and how liquidity behavior and price location come together to create precise trading opportunities. The goal is not to add more tools, but to understand how the right tools work together in the right order. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now, let's start with the basics of the classic fair value gap. A fair value gap forms on the chart when price moves with inefficient delivery, meaning it travels too quickly in one direction without allowing the market to trade fairly on both sides. This quick move creates a liquidity void, an imbalance that the algorithm will later seek to rebalance and fill. Fair value gaps usually appear within a 3-candle sequence and are easy to spot on the chart because they often form around a large displacement candle. The key detail to notice is that the upper and lower wicks of the surrounding candles do not completely overlap the body of the middle candle. This leaves a space between them, which we call the fair value gap zone. It represents the range of inefficiency that price will often revisit later. When the market rushes to reach a specific price point, smart money steps in with a high volume of orders in a short time. This sudden burst of activity creates an imbalance between buy and sell orders, resulting in what we recognize as a displacement in price action, or the fair value gap itself. For example, when a bullish fair value gap forms, the gap between the candles that do not overlap shows a lack of sell orders compared to buy orders. In simple terms, there were not enough sellers to fill all the aggressive buy orders placed at that level, leaving buy-side inefficiency behind. On the other hand, when a bearish fair value gap forms, there were not enough buyers to fill the sell orders, leaving sell-side inefficiency in the zone. These leftover unfilled orders are exactly why price tends to return to these areas later, often reacting or reversing once the imbalance is rebalanced. Fair value gaps help us understand where price is likely to react. But identifying a zone alone is not enough. To trade these reactions with confidence, we also need to know when the market is actually ready to change direction. That confirmation comes from a change in market behavior known as change of character. Price does not react to a fair value gap at random. Before a meaningful reaction or reversal occurs, the market usually shows a change in behavior, where momentum starts to shift and control begins to transfer from one side to the other. This shift is known as a change of character, or CHOCH. A change of character occurs when the dominant market momentum begins to fade, signaling a potential transition in trend and order flow. Technically, it appears as a break in the most recent structure, suggesting that the market environment may be changing. Now, let's see how we can identify a valid change of character in the market. In a bearish scenario, a change of character takes place when the price breaks and closes below the most recent major low and the latest demand zone. The same concepts apply to a bullish scenario. For example, when the price was in an uptrend, consistently forming bullish structure breaks, a shift occurs when it breaks through the most recent major low in the demand zone, signifying the first change of character. The downward momentum continues as the price pushes through the next demand zone and higher low, resulting in a second change of character. This dual change of character suggests an impending shift in market structure. Now, we can anticipate the price entering the bearish order flow. A change of character tells us that control may be shifting, but that alone is not enough. Before acting on that shift, we need to understand the broader environment where price is operating and whether the market is actually trending or simply consolidating. That context is what keeps us aligned with the real move and out of unnecessary traps. Before focusing on entries or confirmations, it is essential to understand the current state of the market. The first step in reading trend direction within market structure is identifying whether price is trending or moving sideways. Price usually behaves in only two broad ways, either advancing in a clear upward or downward trend, or pausing in a consolidation zone where it moves sideways and gathers liquidity. These pauses are a normal part of price delivery. Think of the market as rotating through cycles of rising trends, falling trends, and range-bound periods that absorb institutional orders and liquidity. So when you open your chart, the very first question to ask is this: is the market climbing, dropping, or moving sideways? Now let's break down exactly how to recognize that. In an uptrend, price creates a sequence of higher highs and higher lows. This shows that buyers are in control, gradually driving the market upward. Price usually takes out previous highs while defending the lows. That is why in an uptrend, your primary objective is to look for buying opportunities. The uptrend stays valid as long as the most recent swing low remains intact. But once sellers gain strength and price breaks below that level, the trend is considered broken. For instance, if price falls through this important low, right here, the uptrend may be coming to an end. Now, the same logic applies in reverse when the market is in a downtrend. In a declining market, price forms a sequence of lower lows and lower highs. This time, sellers dominate the movement, driving price downward by breaking previous lows while keeping the highs protected. During a downtrend, your attention should be on selling opportunities. The downtrend only ends when buyers step back in with strength and price finally pushes above the most recent swing high. Now, you might be asking why identifying trend direction plays such a critical role in trading. There is a reason traders repeat the phrase that the trend is your friend. One of the core principles in trading is avoiding positions that go against the prevailing market direction. And that is why recognizing the broader trend is so important. It keeps you aligned with the flow of the market and helps prevent unnecessary losses. But what if you cannot clearly see whether the market is trending up or down? That usually indicates that price is moving in a consolidation zone, often called a range or sideways market. This phase appears when the market takes a pause to accumulate liquidity and decide its next directional move, either continuing in the same trend or reversing once buyers and sellers reach a decisive point. In moments like this, you could technically choose to buy or sell, but the wiser choice is to step aside and observe. The reason is simple. This is where most traps occur, and without caution, you can easily be caught in manipulation. When the market is trending and direction is clear, price no longer moves randomly between levels. Instead, it begins to leave identifiable footprints that reveal where imbalance exists and where price is likely to react next. One of the most important of these footprints is the fair value gap. Once direction and context are aligned, fair value gaps can be analyzed with much greater precision. These imbalances follow specific behavioral patterns, and they generally fall into two main models, each representing a different type of order flow imbalance in the market. The first model is BISI, buy-side imbalance, sell-side inefficiency. This occurs when price moves too quickly to the upside, offering only buy-side delivery. In this case, the algorithm drives price higher so aggressively that there's little or no opportunity for sellers to participate. As a result, the market becomes unbalanced, leaving behind a buy-side imbalance and sell-side inefficiency. To restore equilibrium, the algorithm later seeks to offer sell-side delivery. For example, forming one or more bearish candles to fill the gap and re-establish efficient price action. The second model is SIBI, sell-side imbalance, buy-side inefficiency. This is the mirror opposite. Here, price moves sharply downward with too few buy orders to balance the sell pressure. The algorithm later corrects this inefficiency by offering buy-side delivery, allowing price to retrace upward to fill the sell-side gap before continuing in its original direction. Within every fair value gap, there are three critical reference levels that traders should pay close attention to: the premium end, high of the gap; the discount end, low of the gap; and the midpoint, known as the consequent encroachment. These levels often act as dynamic support or resistance, especially on lower time frames. Among them, the most significant is the consequent encroachment, the 50% midpoint of the fair value gap. This level frequently decides whether the imbalance will hold or fail. In practice, if price returns to the fair value gap and respects that midpoint, it often signals that the market intends to continue in the same direction. However, if price violates the consequent encroachment, for instance, pushing through the midpoint of a bearish CB fair value gap, that is a strong clue the market may continue moving higher, effectively invalidating the original imbalance. As you can see here, after price violates and closes above the midpoint of the fair value gap, it continues its upward movement with strength and momentum. This behavior confirms how important the midpoint level truly is. Now, let's move on to the next concept, the inversed or inversion fair value gap. So what exactly is an inversed fair value gap? An inversed fair value gap, also known as an inversion fair value gap, forms when a fair value gap is disrespected, meaning price breaks straight through it instead of reacting or reversing as expected. When this happens, the gap changes its role and switches its characteristics, often transforming into a new area of support or resistance, depending on the direction of the breakout. For example, let's say we have a bearish CB fair value gap that price should, under normal circumstances, react to and reject from. However, instead of respecting it, price breaks through it decisively. At that moment, the bearish CB fair value gap becomes an inversed fair value gap, now more likely to hold as a support zone on future retests. The same logic applies in reverse, when price breaks through a bullish gap or a demand zone without reacting. That zone often flips into resistance. In short, whenever the market violates a supply or demand zone or a fair value gap, the area inverts its role. Supply becomes demand, and demand becomes supply. To visualize this, look at the example. We have a bearish CB fair value gap that price completely breaks through using two strong bullish candles. This move creates an inversed fair value gap. From this point, we expect price to either retrace into that zone or continue moving higher with momentum. If we let the chart play out, we can see price retracing back into the inversed fair value gap, respecting the consequent encroachment, and then continuing to rise. This example perfectly demonstrates how fair value gaps can flip their characteristics after a violation, acting as powerful support zones for the next bullish leg, or as resistance zones in the opposite scenario. Understanding this behavior gives traders a major edge when mapping out structure shifts and continuation setups. Now, let's move to a real chart example to see how to use inversed fair value gaps effectively when planning a trade. Here we are looking at the Euro-USD pair on the 1-hour time frame. The overall market direction is clearly bearish. Notice how price first sweeps the buy-side liquidity above the recent structure, fills the inefficiency, and then reverses sharply. This behavior sets the stage for us to look for confirmation entries on a lower time frame. Next, let's zoom into the 5-minute chart to locate an inversed fair value gap, specifically a bullish CB fair value gap that has been violated. If you look closely, you can see that after the liquidity sweep, price broke through this bullish fair value gap and closed below it, completely disrespecting the original imbalance. From this moment on, that same gap switches its role and becomes an inversed fair value gap, now expected to act as a resistance zone. At the same time, we can also identify a market structure shift at this point, adding a strong layer of confluence to our bearish bias. With these confirmations in place, we can expect price to retrace back into the inverse fair value gap zone before continuing lower, targeting the sell-side liquidity that lies below. When it comes to entries, there are two practical approaches. The first is a conservative entry, placing a sell limit order at the highest point of the inverse fair value gap. The second is a more aggressive entry that provides a higher risk to reward ratio using the consequent encroachment, the 50% midpoint of the gap, as your entry point. For take profit levels, you can target the nearest draw on liquidity within the same time frame, or aim for a higher time frame liquidity zone that aligns with the overall trend, offering a larger potential gain. By combining these elements, the liquidity sweep, the market structure shift, and the inversion of the fair value gap, you turn what looks like a simple imbalance into a high probability trading setup that aligns perfectly with smart money principles. In this case, I'm going to place my sell limit order at the midline, also known as the consequent encroachment level of the inverse fair value gap. My stop loss will be set just above the swing high, and for take profit, I'll target the nearest sell-side liquidity located below this swing low. Now let's play out the trade and see how it unfolds. As you can see, price pushed slightly higher, tapped into the inverse fair value gap, which acted as a clean resistance zone and triggered my sell order. After that, price reversed and dropped with strong momentum, eventually reaching the take profit level. This move confirms the effectiveness of this trading setup and shows how powerful inversion fair value gaps can be when used correctly. Now, let's move on to another example to make the concept even clearer. Here on the 1 hour time frame, we can see that price has swept the sell-side liquidity below the previous low, marked by the formation of this hammer candle. With that sell-side liquidity now cleared, the market is likely to shift focus toward the buy-side liquidity, giving us a bullish outlook for the next move. Next, I'll zoom into the 5-minute time frame to get a more detailed view of the price action and identify a possible entry for a long trade. On the 5-minute chart, after sweeping the sell-side liquidity, price moved back inside the range of the previous major low and closed above a bearish fair value gap. This action creates an inverse bullish fair value gap. From here, we can anticipate that price will retrace into this bullish inverse FVG zone before continuing upward toward the buy-side liquidity above. So I'm setting my entry with a buy limit order at the highest point of this inverse fair value gap. My stop loss is placed just below the swing low, and my take profit target is set at the next liquidity level above. As you can see, the order was triggered and we're now in the trade. Price respected the zone perfectly, pushed upward with strong momentum, and eventually hit the take profit target. Another clean and precise setup using inverse fair value gaps. Before we wrap this up, it is important to highlight one key point. Everything you have seen in this video works best when market structure and liquidity are clearly understood together. These elements provide the context that allows any execution model to perform consistently. If you want to explore this topic in more depth, we are going to show a very short clip from another video on our channel, where this process is explained step by step in real market conditions. Hack number 1 is to define the trading range before doing any other analysis. The starting point is straightforward. Before looking at anything else, you must first determine the current trading range. So what exactly is a trading range? It is not simply a box or a period of consolidation. A trading range represents the area where price is actively moving and where liquidity is forming. In simple terms, this zone provides the clearest insight into where price is likely to move next once it breaks above or below it. And while price remains inside this range, close attention to price action is essential. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure. so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.